Activist investors facing perpetual challenges, convincing regulators and shareholders to face the facts. We've got an expert on that subject with us, an exclusive with hedge fund manager William Ackman. He's managing partner at Pershing Square Capital Management. He joins us with guest host David Einhorn. And if you ever wondered what the business show of record is, it's bringing guys like Ackman on here that say it just about every day. I think you come here on Squawk Box.
Great.
Thank you for coming on.
Thanks for having me.
We've been talking about marking to market in the bigger sense. And we should point out, you make a lot of money on the long side. Wendy's, he said, it was kind of cute because he said, I just want to first just let everyone know it's at least $2 or $3 long versus $1 short. You don't want to be labeled a short seller. And would you say $2 or $3 long for each one short, or even more long?
First few years of our existence, we made no money on the short side. Last year was a majority of our 100% of our profits came from short selling.
So it wasn't Wendy's or stirring up things on the long side of things last year?
No, we took a break from that last year.
My question now is, and I thought of something else, David, we were wondering whether there's some smart people that say you don't need to mark to market if you're going to hold these things to maturity. There's no reason to go through all this pain and all these distressed sales with some of these companies if you just let things go. And I came up with a 30-year bond because I have to think slowly. I was a stockbroker. I remember when rates went up, that bond was worth half as much. But that's not coming due for 30 years. What if it's a 5-year piece of paper? Do you really need to mark that to market to be fair for a company?
Sure. I think Goldman Sachs is probably the best example of this. But Goldman Sachs' risk management, as far as I understand it, comes from the fact that they, in a very disciplined way, mark to market.
On a daily, if something's coming due in a year, they'll market to market.
Minute to minute, the trader says, I can't get a mark for this. Lloyd Blankfein says, okay, fine, sell 10% of it, that's your mark. And I think that kind of discipline has helped Goldman Sachs avoid very significant losses.
No matter how illiquid something is, I mean, you can't mark limited partnerships mark to market, can you?
Sure you can.
You try to sell some, try and sell 10%. So the most esoteric derivative can be mark to market on a daily basis.
I think the more esoteric it is, you have to give some information on how you're calculating that mark to market, and I think you might want to give a range.
Well, then that's a problem. Then we still have a lot of work to do with financials at this point?
Probably.
How far, Jamie Dimon says we're 75, 80, 85% done cleaning up this mess?
I mean, maybe J.P. Morgan is. I don't know about, I mean, AIG, not that long ago said pretty close to being done. The problem is that when you've got a structure like a CDO, where the underlying assets, in some cases, are CDOs, and then underlying them are asset-backed securitizations, and then underlying them are mortgages. I think Buffett's made the comment that to understand a CDO, you've got to read 750,000 pages of prospectuses. That's one CDO. It's a little difficult to figure out.
How do they look at these things? Just on models that may or may not be accurate?
I think so.
Let me go back to I don't know if you saw our segment where we were talking about whether short sellers are scum or whether they're just investors, and we decided that they were just investors on the long side version. And if you come and hype a stock, you come and say, wow, you remember some of these great story stocks of the past. They've got technology, Alchemist, whatever, the cold fusion, however you want to look at it. If you tout it long, is it any different than trashing it short?
I think, I was actually, before I came on the show, I was thinking about short selling generally. Maybe good advice to give an investor. When should you listen to a short seller versus otherwise? And I think, if you go on a message board and there's some anonymous guy saying this company's a garbage, that's not good enough information. But if someone gets up in front of 1,000 people, makes a 20-minute presentation, you should pay attention to that.
Okay, so we understand it works with Enron.
I've got to keep going, though. Then if someone gets up in front of an audience and then after doing so gets investigated for doing so, still stays short, you should pay attention. And then if that person writes a book and commits to give away 100% of the profits, you really should pay attention.
Well, then we're going to be watching ALD today then, because then it's going to be, because we're certainly highlighting that this morning. The other point I was getting through, what about like a Bear Stearns or a Lehman, where, I mean, did Bear Stearns need to be sold at $2 a share, or was that, and did Lehman need to come close? Weren't some of those scurrilous, untrue rumors that had been circulated by short sellers?
I don't know what rumors were circulated by short sellers, but I think Bear Stearns came quite close to going out, and I think had it not been rescued by J.P. Morgan, unfortunately at the expense of of shareholders. I mean, one of the issues Bear Stearns, perhaps Bear Stearns could have been a little more disciplined about marking to market and thinking about.
But we heard it was a liquidity problem, not a solvency problem, right?
$2 is pretty close to insolvency. When you got a $400 billion balance sheet, equity is 3% of your capital. Very small changes in the value of your assets wipe out, the difference between solvency and insolvency.
Well, I just want to get from both of you, how well do you two know each other? How long have you known of each other, and how long have you been friends?
I don't know, about 12 years or so.
Long time.
How did you first get to know each other?
I think we met on a subway platform.
Seriously?
You're joking.
No.
It's true. I meet the nicest people on subway platforms.
Knowing who each other was, or just met blindly?
Actually, we were at a lunch, and we were both there. We left, and I happened to be engaged on the subway platform.
Do you two have very similar thoughts about how you go out and deal with Wall Street?
I don't. I think we have. Look, I mean, Bill's a phenomenal investor, and I think though he has some different philosophies than I do, and he constructs his portfolio very differently than I do, and his returns are absolutely extraordinary. It shows there's a lot of different ways to go about things, but he's a fabulous investor.
David's my marketing advisor. I'm his book publicist.
Are you going to make 100% of your profits this year by going short as well?
It's possible, but I think we'll make more money in the long side this year.
Can you tell me the question?
Well, can I ask why?
Yeah, go ahead.
I think it's more difficult to be short in 2008 than it was in 2007.
Because the markets are going to
we were
stronger?
able to, the way that we've been short principally has been buying credit default swaps, which are these insurance policies on companies defaulting. And in 2007, you basically could buy insurance on a company defaulting and pay almost nothing.
Right.
So your downside was very, very small. Paulson made a fortune this way, basically taking on a bet where the downside was very small. He'd lose a couple % of his portfolio, and the upside he'd make 10 times.
Well, then that
portfolio.
Sounds like it backs up what Jamie Dimon said, that maybe we're 85% through the credit crunch. Maybe those opportunities are harder to come by?
I think those opportunities are harder to come by.
What about the people that would have made money if Bear Stearns defaulted? Should they be unhappy?
No. No, I think
they put the money out for the credit default swap, and they never got paid off, though.
I think that's the risk you take.
That someone's going to come in and totally change the games and of the...
Absolutely. I mean, the problem with, I think if you were 100% short seller...
You'd be mad, wouldn't you?
You'd only want the world to come to an end. I mean,
right.
What's good about being a long short is that you can still be, you want good things to happen for America and not be concerned.
In what areas are you long?
Yeah, we want to find out things that you're doing before you're going to do them.
And unfortunately, those are the things that we told you that we couldn't talk about today.
No, but
It's just between us.
you said we could ask anything, but you get to decide what you... There's no... Yeah.
That's fair. You can ask me whatever you want.
Which things you definitely not want us to ask you about today?
That's an excellent question. Even I don't know. Those are the ideas I'm looking for.
I want to know the things that would really get you to go, wow, I'm not going anywhere near that.
Please try.
All right, how about MBIA? Where are you on that?
Delighted to chat about it.
All right, so what's your position now?
We actually don't comment on precise what we're long or what we're short. But we are still short MBIA, and we still have the same views. I mean, MBIA is announcing earnings on Monday. I encourage you to pay attention. I think it will be quite an interesting conference call. We've historically not been allowed to be on the MBIA conference call. One of the things I think you should look for is a sign for companies that you don't want to own, or when they don't allow, when they restrict the people that can go on the call.
That was where my last question came from. You find out which companies you can't be on the conference call. I want to know which questions you definitely won't answer.
You know what I'm going to do? I'm going to put out a list of questions publicly, and I'll be happy to send it to CNBC.
Or questions you would have for MBIA
with the conference
if
call.
we're on the conference call?
And I'd be delighted for you to ask them on there, and I think that would be a very good way to do it.
Overall, do you ever think tops down?
What we do is we look for businesses where we think they're not likely to be materially affected by extrinsic facts. If interest rates go up or down a couple hundred basis points, if oil prices go up $25 a barrel, we try to find very robust, stable businesses, generally very modestly levered, and as a result, we don't need to think particularly top-down. We don't need to think about exactly where interest rates are going to be for us to do well. And then we look for a big discount. If we can buy something for 50 cents on the dollar, yes, Target is going to be weaker in a difficult economic environment.
Where are you on Target now?
We're a big believer.
Your latest filing was where?
Latest filing, we own just under 10% of the company in terms of beneficial ownership, and more than that, economic ownership. So we're big believers, and we're a 13D filer. If that were to change, we'd have to file.
Yesterday, Target was a little disappointing, especially when you look at what Walmart did. There are a lot of people who think Walmart is getting the upper hand on Target after a long time of playing second fiddle.
I think that we don't think really month to month or quarter to quarter. I mean, the value of a business is the present value of the cash you can take out of it over 50 years. You know, the next year is worth more in that calculation than a year 50 year out. But one of the things I find interesting about retail stocks, for example, is that no one wants to own retail stocks if we're in a recession, going into a recession. But if a business is worth the present value of the cash you take out over 50 years, you're going to have 7 recessions. Why does it really matter? You know, you should think more about what you're paying versus what the business is worth, as opposed to what you're paying versus what they're going to earn next quarter.
Those parameters you gave us for what makes an attractive investment, are there, even though you don't do top-down, are there sectors that offer that you don't have to mention names, but are there sectors that offer that type of criteria?
We're less of a sector focus. We focus on things
on individual companies.
The things we can understand. I mean, I think that's the important